This just in, breaking news. We just got the top countries that produce the most plastic waste. China leads with 37.6 million tons, followed by the United States with 22.9 million tons. Together, they surpass the combined total of the next 8 countries. So let's speed through this. We have India at 7.1 million tons. That's a lot of waste, bro. How do I help, you think? Sustainable investments, bro. Huh? In 2023, the size of the global sustainable finance market hit 623 billion USD. That's almost the same size as Singapore's GDP. For this year's Earth Day, we'll be taking a look into how you can make a difference for the planet and society while you make a difference for your pocket as well. Sustainable investing is all about how investors and companies incorporate environmental and social governance when making their investment decisions. It encourages taking a step back and thinking about how their investments not only generate returns, but also contribute positively to the world. The concept of sustainable finance has actually only been gaining more traction in recent years. The interest in this field grew exponentially just 6 years ago in 2018, when more companies and consumers became increasingly conscious of their impact on the environment. Now let's find out how it works. We can categorize sustainable investing into 2 main types. Number 1, sustainable investments. Number 2, Fintech solutions. Sustainable investments looks at directly generating positive ESG impact, while the latter serve as solutions to assist in the process of investing. ESG funds. The funds consider environmental, social, and governance factors alongside traditional financial metrics when selecting companies for their investment portfolios. These funds invest in bonds issued by companies that incorporate sustainability, as well as ESG factors and frameworks. So, what's the difference between these funds and other funds? There are 3 differences between these 2 funds, specifically the investment approach, objectives, and the risks and return trade-offs of each fund. ESG funds are all about finding that sweet spot between making money and doing good for the planet and society. Impact funds are another way you can invest. It pools money from multiple investors to invest in companies or projects that align with specific social or environmental goals. Impact funds usually offer diversified portfolios and professional management. Another type of sustainable investment is through bonds, namely social impact bonds and green bonds. Social impact bonds provide financing specifically for social programs. They offer a results-oriented approach, targeting issues such as healthcare access, education attainment, and poverty reduction. One example of such bonds is the Singapore Prison Services Rehabilitation and Reintegration Program. Another way the industry strives to make investments more sustainable is through green bonds. Green bonds are a type of fixed income security that are specifically designed to finance projects that have a positive environmental impact. Similar to traditional bonds, investors loan money to an issuer, the government, or a company. Investors do so for a set period of time in exchange for regular interest payments and the return of their principal investment at maturity. In February 2016, Apple issued its first green bond, raising 1.5 billion USD. The bond was aimed specifically at funding environmentally sustainable projects across the company's operations globally. They have managed to reduce carbon dioxide emissions from offices, data centers, and retail stores worldwide by 60% since 2011. With the increase of eco-consciousness in the world, there are many innovative fintech solutions that are helping steer us into a more sustainable future. Carbon offsetting platforms are fintech solutions designed to help individuals, businesses, and organizations compensate for their carbon footprint by investing in projects that specifically reduce or remove greenhouse gas emissions from the atmosphere. These platforms typically operate by connecting carbon offset buyers with verified carbon offset projects, such as reforestation initiatives, renewable energy projects, and methane capture programs. So don't think it's too late to start doing something about the carbon footprint produced from your actions, because you can compensate for that starting now. Next, we also have green crowdfunding platforms. They leverage fintech to facilitate crowdfunding for environmentally friendly projects and initiatives. Platforms like this enable individuals and communities to raise funds for renewable energy projects, sustainable agriculture, conservation efforts, and eco-friendly products, to name a few. This means you don't have to be very wealthy to be able to make an impact and contribute to making the world a greener place with your finances. Risks and challenges are always present in life. ESG helps us to identify companies that are well-positioned to enjoy financial benefits and drive change for a more sustainable economy. However, there are definitely hurdles that may dilute the intention of ESG. One of the significant risks of ESG is the prevalence of greenwashing, where companies exaggerate or misrepresent their environmental or social initiatives to appear more sustainable than they actually are. Investors should have a clear picture about what they're investing in, as opposed to feeling suspicious about where their money is actually going. For instance, a company might tout its minimal environmental impact while neglecting to disclose significant pollution or labor violations in its supply chain. One notable case is IKEA, where they were linked with illegal logging in June 2020. They also built their most sustainable store in Greenwich, London in 2019, but not without demolishing an already sustainable building. To combat greenwashing, investors and regulators increasingly demand transparent and standardized reporting on ESG metrics. In some cases, ESG funds may include companies that appear counterintuitive to the fund's objectives, such as large oil and gas corporations with substantial carbon emissions. While these companies are significant contributors to climate change, fund managers may include them because they are doing better on ESG principles than their competitors. This can mislead investors, as a lot of them may not go in depth on what companies there are in the funds and simply skim through the funds and pick the ones that they believe are aligned to their goals. Despite efforts to standardize ESG metrics and methodologies, rating agencies often use varying criteria and data sources, leading to inconsistencies in assessment. For instance, a company may receive a high ESG rating from one agency, but a significantly lower score from another due to differences in evaluation criteria. ESG funds may incur higher fees compared to traditional investment funds, posing a challenge for investors seeking to align their portfolios with sustainability goals without incurring excessive costs. The higher fees are often attributed to additional expenses associated with ESG research, screening, and monitoring processes. While some investors may be willing to pay a premium for ESG integration, cost considerations remain a barrier for broader adoption of sustainable investing strategies. However, as demand for ESG investing grows, the cost gap between ESG and traditional funds is expected to narrow. So, it's not that hard to incorporate sustainable investing, is it? There are so many options to choose from. Maybe start looking into the investment type you prefer, and you can create a positive impact on the world too. With that, happy Earth Day, everyone. Remember, leave the world a better place than how we found it.